Hi, everybody. This is Chris Wiley with Wiley Development and Tasty Equity. Thanks for joining us for our monthly webinar series. We're going to stand by for just a minute as everybody gets logged in. I see we got a bunch of folks that are here early. Thank you very much. We'll stand by. You should be able to see my screen now. We'll have a little bit of warm-up. We'll talk about this event, what we've done in past events, and how you can go watch highlight reels of our past events. So I will stand by just for a minute while we get everybody settled. Again, thanks for joining us today. Hi, everybody. Chris Wiley here. Just warming up real quick. We have everybody getting settled in. It takes a minute or two to get everybody logged in and at the on the screens. I think you can see my screen now. I'll try not to stare up at the top of the monitor, and we can have a little bit of fun. We'll cover a little bit of history on the events we've been doing in the last 6 to 9 months, the topics that are there, how you can go back and look at them via our YouTube channel and view them in little 10 and 15-minute segments. I'll stand by for about 1 more minute, and then we'll kick this thing off. Thanks, everybody, for joining us early today. All right, everyone. Thanks for joining us today. I see we have most of the folks that are registered are settled in. Today's event is going to be 60 minutes. We're going to cover 4 topics. Those topics include some history on the fast casual space. We're going to look at the capital velocity and the kind of opportunity that creates for those of us who operate in fast casual, citing some industry reports. We'll talk about what happens in our own race to 200 stores, why we call it that, what happens when you get to 200 stores, and why it matters. Then we'll touch on, for 15 minutes, the fast casual industry dynamics and why our market segment is outpacing the rest of the market by 250%. And then we'll talk about 4 ways that you can participate in this channel, in this market segment, with us or independently on your own. Hopefully the ideas we share today will inspire you to move forward either in your business or collectively with our business. This is the, I guess, 7th or 8th event this year for us. We've had several other key topics that we've covered in a variety of events. Social media marketing was very, very popular. We talk about how we introduced it into our brands a year ago, where it is today, the kind of results, and why you have to play in it. You will not accidentally be successful in social media. It either hurts you or you win at the game. We'll talk about that, how that works in those events. You can see them on the highlight reels on the YouTube channel. I'll show you how in a moment. Fast casual alcohol has been game-changing in the industry. It is emerging. There's less than 400 operators in the nation, including bars and restaurants. We've adopted it in a number of our locations as a pilot over the last year. We're in the event we did on fast casual self-pour alcohol. You can learn about how you could retrofit it to your business, what you can expect, the opportunities and the challenges. And we've talked a lot about restaurant tax incentives. Why my brother Ray, who's the founder of Rapid Fire Pizza and Hothead Burritos, always said over the years, never, never, never stop building stores. The tax incentives are a driver. Uncle Sam wants you to create jobs, and you can go back and watch those events. Those are also intertwined with the capital financing and locations events, where we talked about build-to-suit partnerships, how you can accelerate your development by having a multi-brand strategy, which we'll talk more about today. All of these are available on our Wiley Development Group YouTube channel. This is new for me. I guess this is what you would call a video podcast. But we had a lot of requests from folks who've joined us to chop these up into 10-minute bite-sized pieces that you can watch on a treadmill or listen to while you're driving down the road. So that's what we've done. You can go back at your leisure and check these out. I'd like to start today off with a quick warm-up poll. We're going to do 4 or 5 polls through the course of this event. If you could be so kind as to grab your mouse and share with us what really describes your background. This will help me adjust the topics we're covering today and how we go about it. Please let us know what kind of perspective you bring to the audience and what the nature of your business is in this space. We'll be quick about these, try to get them done in about 30, 40 seconds. Thanks, everybody, for clicking away. It's always interesting to see who's taking the time out in their day, and we do see an awful lot of people go back and review these after the fact as recordings. I see that, like us, there's a bunch of multi-store or multi-brand operators in the audience. And for those folks who are pure play investors or completely new to restaurant franchising, hopefully this will open your eyes to why there are so many firms aggressively pursuing operations in this space. With that, we're going to move ahead to what we're going to cover. Again, we're going to cover the fast casual case studies about capital and velocity and the opportunity that presents for you in this space. Next, we will cover what happens when you get to 200 restaurants and why it matters. Then we'll do 15 minutes on the fast casual industry dynamics. I think you'll get a kick out of this. They're really quite stunning. And then 4 ways to participate with us, as I said at the top of the call. So with that, I have another poll to get a little bit of perspective on our audience. I'm going to try to control my screen here, and here we go. If you could, grab your mouses. One more bit of perspective. Which casual or fast casual success stories are you familiar with? If you've been in the space as an investor, an operator, or simply a consumer, these are household names, I would think, in most cases. I'm curious which brands you guys have seen happen. We're going to talk about a couple of these today and why they are essentially proof of concept for how our brands fit into the business. Thanks, everybody, for voting, and let's see. Mod, certainly I live in Seattle, even though our business is in Ohio. Mod started here, old Seattle coffee people. Blaze, very popular, at least half the people in the audience know it. Qdoba, a little bit less national penetration. Chick-fil-A, not exactly in our space, but they certainly are a leader in service. And Chipotle, we will talk a little bit about their results. Obviously, everybody's familiar with them. I ate an awful lot of Chipotle in my day and continue to do so, except when I'm at our stores. Tier 1 investors in the restaurant industry just have an endless appetite. What I tried to portray here, this was a compilation of information published by National Restaurant News, literally this month. What they profiled is the largest operators of restaurant brands and food services brands. The single unit brands or single brand operators are those that are typically the franchisors or the corporate operator of a single brand. The folks with 2 to 5 are often an operator like that or a franchisor with 1 or 2 brands, maybe like Ray at Hothead and Rapid Fire. But those folks that I highlighted in green, the private equity firms that operate more than a half a dozen brands, or aggregators who's aggregated even more than 20 brands under the same operating company, are making moves in this market. For the last 2 years, those firms collectively have generated more than 10% year-over-year growth in their businesses, and 75% of that is literally the result of them acquiring brands. I have friends that have come out of the firms like the Rourke's and other big, well-known PE firms, and from some lesser-known firms in the space, folks like Corlex Capital that really came out of Rourke. Those players are constantly searching for emerging brands that are at 10, 15, 20, 30, 50 stores. The 2 different tiers of operators are, there's some that seek the small operators that are ready to franchise or are already franchising, and then they try to ride them up to 200 stores and then sell that brand off to the big aggregators or private equity firms. The larger funds don't come in until you get over 200 units. But what I'm trying to present here is that 25 of the top companies in the world that operate food services businesses, largely restaurants and a very high concentration in QSR or limited service restaurants and emerging into fast casual, are these folks that have between a half a dozen and 21 brands. They are making the market that we are building our restaurants for. This is a compilation from Aaron Allen Associates. They track mergers and acquisitions. They advise on it in the space. And what's interesting about it is that as the acquisitions have continued to happen year over year and the consolidations in the really large brands, the EBITDA valuations that they pay for a restaurant are going up and up and up. And whether it's a restaurant, a group of restaurants, or a franchisor, these deals typically are hundreds of restaurants in a transaction. But there are second-tier private equity firms that literally are out hunting constantly for bundles of 20, 30, 40 restaurants. They love the cash flows. They love the space. They're looking for established operators that may be independent franchisees. They may be corporate stores within a system. But you think about this, folks. When I go to the bank and borrow money to build a restaurant, a typical valuation is the cost of building the restaurant. And once that restaurant operates for 12 months, the valuation is 4 or 5 times EBITDA. These transactions are trading at more than 10 times EBITDA, which means if I build a bunch of fast casual restaurants, aggregate them together, operate them successfully, and ultimately in a couple of years deliver them to a private equity player who buys into the business or simply acquires stores or hires my management team to run those stores, I can literally double the value that I've created from the time the stores were built. And you'll see this other measurement, which is the 1.4x multiple of revenue. In a simplistic fashion, they're buying cash flows. They're buying based on a multiple of revenues as long as the EBITDA margins are there. And you'll notice on this slide, there's a modest amount of activity in the fast casual space on the top right, and literally some QSR brands still popular. But think about it this way. Fast casual is the single smallest segment of the entire market, and yet it represents something on the order of 20% of all the acquisition activities that have happened. I'd like to jump into a couple of case studies that are examples of where we are. What I want you to think about is the rate at which these businesses open stores, how long it took them to get to critical mass, what value was created when the exit occurred, when the transaction that brought in private equity or an IPO type event occurred. And you'll notice where they are in terms of AUV. So Chipotle, everybody knows it sort of helped define the fast casual segment. I would argue that the line service style of Subway actually helped define the segment. But Chipotle, with its healthy menus and such, really crystallized that. Look at the kind of money that an investor like McDonald's made, where they got into that business when it was young. They exited a few years later at 500 stores, and literally, what is that, 4 or nearly 5x return on their money. That's why PE firms are in the space. That's why big franchisors occasionally pick up smaller brands. Today, that system, we don't have to read you the slides, but it's billions of dollars a year in sales. Despite its fall from grace a couple of years ago, it's come roaring back with the hiring of a CEO. Shows you how sensitive brands are to leadership. Literally, they're driving dollar per checkup through their limited time offers and their unique ways of repackaging their products in the Taco Bell-izing of Chipotle, as I like to say. And even they have rising food costs, but they set records. They were all over the news. Their quarterly reports put their stock as high as it has ever been, and their AUVs are starting to recover. I cite Chipotle because you can't franchise Chipotle. They're all corporate stores or JVs. This is our benchmark that we compete against. In markets where we're entering the market, Chipotle may have 15, 20, 25 stores. People know how to eat the product. I put the pictures in. It looks just like our product. Our product has more stuff, and we'll talk about why I believe we have a second mover advantage in a minute. But take note of the fact you've got a business that, like Subway, was opening over 100 stores a year. I think Subway even achieved 1,000 per year, but they're not that far away from the AUVs that we have. Qdoba, which I believe helped inspire Ray more than a decade ago, my brother who founded Hothead Burritos, when they created their business in the wake of what was Chipotle's kind of meteoric rise, it took them a lot of years to get to 50 locations. They went through multiple brand changes. But that first transaction was a $45 million transaction that was built for a fraction of that. And that, while it became sort of a redheaded stepchild underneath Jack in the Box, which was really an LSR quick service business, the deal still spun out just recently for over $300 million. I use the example with Apollo Global Management because I know the Apollo teams from other capital markets work I do. Apollo is just the deal leader among many private equity firms that put that deal together. They bought what they believe was an undervalued business that had lots of growth. Look for them to come back with a vengeance in the market. But again, I'm using these two case studies because you can't franchise Chipotle, and Qdoba has licensed out most of the biggest, most popular markets. So the opportunity to get in the Qdoba system and control a greenfield market where you can put up 5, 10, 20 stores just doesn't exist. Note their AUVs at 1.13 million. I'll show you a chart of AUVs in a bit. They're lower than Chipotle. Chipotle defined the segment. They're right smack in the middle of where the players are clustered in pizza and Mexican. Let's transition to pizza for a minute. I'm going to show two examples. Mod Pizza came out of Seattle, the old Seattle coffee people. They raised a ton of capital. We found ourselves as a brand competing with them for locations where they were going out and signing leases, just tying up property. They announced recently that they are on their way to reach 1,000 locations in the next 5 years. They've been opening about 100 locations a year. The reason I'm citing that is we currently open about 1 location a month per brand. So, 12 or 15 stores per year per brand. 100 locations a year is achievable with a mature area developer network. Today, we have about 15 area developers in our Mexican brand and our pizza brand, and they may get to 3 dozen stores a year or 4 dozen stores a year now that many of them have been settled in with for a time. What I'm trying to demonstrate here is 100 stores a year is not unreasonable. Our goal is to get to 200. We're at 112. These guys, it took them a long time to reach 30 locations, and now they're clocking off 100 a year. They've raised $350 million. Again, this event is about the amount of capital flowing into this market. They've funded 6 rounds. They didn't even make money for the first couple of years. They were simply tying up real estate, creating a brand, crossing people over from major brands, and much like we'll talk about Blaze in a minute, they were licensing out markets in high-profile license deals to operators so they could claim the turf. And now you got folks like CDR. CDR is not in here to make a little money with their money. CDR chases transactions. So this is big, big money coming into the space where we compete every day. I believe they're not a threat to us. We have a second mover advantage we'll talk about again in a minute versus Mod and Blaze in our pizza system. And notice their AUVs. Their AUVs at $9.98. They've slipped a little bit with store densities coming up, and they've also had some operational challenges. But again, I'm not knocking the brand. They have a good product. There's one 5 blocks from my house. I eat there occasionally because there's no rapid fire in my neighborhood. But the reality is that they are right in it neck and neck with us. And they have literally achieved 400 stores in a very modest amount of time, again, clicking off 100 a year. Blaze technically started a little later. Blaze, it took them, till 2015 to get to 50, 60 locations, 2014 to 50 locations. They're not opening quite as fast as the Mod stores are, slightly different strategy, but they've covered more markets faster. They use a flag planting strategy. Well, that's great for them. It's not great for you if you didn't get in on it, because you can't necessarily go get Chicago or Fort Lauderdale or Dallas or LA because very high profile operators crossed over to get there. Again, I'll talk in a minute about why I believe our second mover advantage puts us head to head against them. But the important thing to understand is they are doing 60 locations a year. We can do 60 locations a year by further expanding our area developer network. Their valuation at $250 million in 2017 literally took LeBron James with his famous stake equity position he took and made his $1 million worth $25 million. I'm citing that example because getting into these businesses when they're at small numbers of units and riding them up as they get brand penetration, national recognition, media power, it has a logarithmic effect on the value creation. And that's why you see multiple rounds. I think they've had 6 rounds altogether. Mod had 6 rounds. These guys have had multiple rounds, notable names in both restaurant-specific private equity and not restaurant-specific private equity. Again, they have clearly expressed that they are going for an IPO. They want to get there at 500 locations. Last published, we saw that they were at about 1.4 million in AUV. I haven't seen an FDD from them recently, so I don't know that that's changed. We understand there's been a little slide in that, but they're literally at about 300 stores. They covered 42 states really fast with their flag planting. We came into this space. Again, the market's hot. We saw it. Ray jumped into this thing back in 2007. The total number of burrito shops in the business, including Mod and Qdoba and Moe's and Taco Del Mar and the like, was less than 500 units between all the brands. Ray took the approach of second mover advantages. Let's study them, let's find out their weaknesses, and let's trump them. He went with almost twice the number of ingredients. He went with dozens of sauces that allowed people to flavor the product any way they wanted rather than accepting it the way Chipotle or Qdoba defined it to be offered. We allow people like sweet to have sweet and people who want creamy to have creamy. And because we were a younger brand and we're more nimble, when online ordering came online and we started to see Uber Eats penetrating the big small towns we're in, we embraced it. We were able to turn on a dime, and we've seen stores literally achieve, double-digit percentages of sales, like 20% of sales in third-party delivery. We expanded from the traditional fast casual into our cantina format back in 2018, and then one-upped that this year. The franchisor opened their first store with self-pour alcohol in a cantina format. Again, I'm showing the pictures. This is head-to-head. Very similar food product, very similar food category. We think we're doing it with more product, with more opportunity in markets where you can get control of an entire market if you miss the boat. You couldn't have missed the boat on Chipotle, but you missed it on Qdoba. And the same thing applies if you miss the boat on Mod or Blaze, which again played out to large operators crossing over to be part of that huge expansion. We believe our second mover advantage is speed. It's variety. We have more variety. We use bigger, faster ovens. Ray realized that those craft ovens that you have in those brands that are hearth-based, gas-fired ovens, you only have 8 or 10 pieces at a time in them. We've got 3 racks of high-speed conveyors with 2 belts each. We can handle the online orders and the third-party delivery without disrupting our in-store customer set. So the second mover advantage allowed us to enter the space, to literally sail in the wake behind the market that was defined by Blaze and defined by Mod, but overcome the customer frustrations with really long lines during lunches and dinners, with disruptions to the service experience when online orders and third-party delivery took off. We believe we're better at it and faster at it, and we have a greenfield opportunity together. Our stores have now achieved velocity. I talked in the beginning about how many years did it take these other big brands to get to 500 units. Well, we're at 112. We got there in about 12 years, but now we're at a store of brand per month. There's 2 franchisors. They're in parallel. They have similar operating and related operating teams behind the scenes. We're going to talk about a multi-brand strategy in a minute, but we have consistently, year over year, deployed more and more stores, the vast majority with franchisees, but plenty of corporate stores so that we eat our own dog food and try everything ourselves. We hit that remarkable run rate. I think Hothead Burritos achieved $1 million a week in system-wide sales in 19 and combined about $1.5 million per week. So we have critical mass. We're marching towards that 200. We want you to join us for the race to 200. If you're doing well in your brand, that's great. Take away some of these ideas, maybe put the pedal to the metal and really start your expansion. But if you are on the fence or you're in a brand that's landlocked, you can't put any more stores in, you don't want to drive more than 50 miles, I'll show you in a minute how you can join our brands, double down with the flexibility and optionality of pizza and Mexican, and I'll make the case for why you want those 2 categories. We have commitments from our area developers in about 15 states nationwide that literally, if they stay on track to their 1 to 3 stores a year commitments, we'll get to 700 stores in a number of years. But 200 stores is like the 3rd step on the ladder. We believe we can get there in the next 2 to 3 years, and I think you want to be a part of it. I'm investing to be a part of it. That's what my business is about. With that, we'll take a pause for a second. Elena?
Yeah, so in our exciting race to 200, we've established that our brands, with the second mover advantage, I think this is really key, and Chris is going to talk about that a little more. We're really building on proven case studies and how we can continue to build on that and implement our specific strategies that are unique to our specific space, of the fast casual space. And so we really think we've got something differentiated here that we're going to build on a little bit more. So let's talk about, though, what happens when you get to the 200 restaurants. What exciting developments come there? Go ahead, Chris.
Perfect. What I'd like to do is let's jump into a quick poll one more time, make sure everybody's still awake out there. Thanks for you who joined us late. Let's see. Everybody grab your mouse finger or your mouse. And again, we appreciate you participating. Give us a little feedback of who's in the audience and what the perspectives are. Which of these QSR fast casual public offerings are you familiar with? If you track the market, if you followed it at all, does it make any sense? Are you, completely detached from that or focused on just getting your own business run? These are some big names. Some like Freshie may not be so familiar, but they have defined the IPO market, and that is a driver in public sentiment and what drives these big investors to want to put money in the space. I see a few of you have actually heard of Freshie, probably folks that have been around me and maybe been to one of our events. The gentleman, the CFO, took Shake Shack public as an acquaintance of mine. I've heard the story from the inside. He's a big fan of ours from the sidelines, hoping that we get where we want to get. And folks like Fatburger did a Regulation A offering and raised a substantial amount of money at around 100-odd stores. Wingstop was one of the bigger IPOs in the space a couple of years ago. I just saw an article about how they're now 25 years old. Not that long ago they had their IPO, but 25 years old, still growing AUV, still building locations. This fast casual segment is rocking. It's not slowing down. So let's talk about what happens when you get to 200 units. The private equity firms and the aggregators that I talked about at the beginning, and which have done all these deals these last several years, they are chasing cash flows. They're trying to grow their operating margins and their cash flows for their investors. The vast majority of their growth is being generated by buying brands that have achieved scale. It's faster and easier than organically growing stores. I think the statistic is about 25% of their growth comes from the brand they buy opening more units, but 75% of their growth each year is created by them acquiring brands, and they tend to focus on brands. I'm talking about the tier one players, tend to focus on brands that have at least 200 units. There are a lot of smaller family offices and private equity players who get involved at 20 and 30 and 50 units. But the reason these big guys are doing it is they're looking for the 200 unit unicorns. They're looking for the rare franchisor who makes it to 200 units, holds the ship together, has a development pipeline out there of maybe another 100 units where franchisees and area developers are selecting locations. And when they go after the transaction, they're looking for profitability, right? It's no good to do sales if you don't have profitability. But when they see the 200 units and they see the revenues and the profitabilities or EBITDA targets, then they go after the entire system. Many examples of this. I'll cite a couple in a minute. They don't just buy the franchisor. Franchisors are very sexy, or the corporate operation, but the cash flows are coming to the restaurants. The restaurants have 10 to 1 or even 100 to 1 cash flows versus the franchisors, which is why any sort of transaction in the future that involves private equity or brand aggregators or public offerings, any of those kind of transactions, and I'm agnostic as to where the brands might go. I'm just saying at 200 units, something good happens, and everybody wins. The franchisor, the corporate stores that the franchisors operate, the independent franchisees who've been in the system, like when my family friend Dan Carney, and my dad was one of the first pizza guys, Dan said they made over 100 millionaires when they IPO'd Pizza Hut, because the Pizza Hut franchisees way back in '68 decided to throw in their stores into that IPO and became instant millionaires in like 1968. So franchisors win, corporate stores become part of the deals, independent franchisees who choose to throw in, they don't always, but some do, and the area developers that control markets have a lot of leverage when those kind of transactions occur. And as I summarized over on the left, the drivers are basic fundamentals, blocking and tackling. We've got to have store opening pipelines. We've got to have velocity of store openings. We'll talk about AUVs in a minute. $1 million plus AUVs are critical because it gives you flexibility on rents. It gives you flexibility on payrolls and costs. And those strong bottom lines are let's call it a threshold by which you are judged. And lately, the high percentage of off-premise has been a very fashionable driver in these acquisitions. We've all noticed brands like McDonald's and Burger King remodeling to very few interior seats because they are food factories. I think QSR Magazine this month had an article about they're introducing effectively Siri for ordering food through the drive-through lines because it's more reliable than humans. We are not, in our particular business, driven by drive-thrus. Our business is not particularly well suited for drive-thrus. But third-party delivery, if we can figure out how to do it more profitably, has become a very substantial part of our business. And in the Mexican space, as pioneered by Chipotle and Qdoba, catering is a big part. So catering is off-premise. Third-party delivery is off-premise. Again, what happens at 200? Everybody wins. Nobody individually is trying to make it happen. We're all collectively working to get to that 200 units. Here's some examples of transactions that were not public offerings. Sonic was a recent one. I didn't realize it occurred. That was a Rourke Capital deal under one of their smaller brands. Brands like Rourke are so big at $4 billion in assets that typically they have sub-brands, sub-units that try to incubate these smaller brands. It's hardly, you could say incubate Sonic, but get the deals rolling, bring them in-house and get control. JAB has been acquiring everybody in the planet to get control of coffee and go head-to-head with Starbucks. But the valuations on these deals are substantial. A Pizza Hut family friend of ours sold all of his Panera Breads into that JAB deal, and that was his retirement at like 79. Popeyes, right? It's been around a long, long time. It's still out there. It's still happening. An RBI example doesn't necessarily control the franchisors, although it might in this case. But again, a series of deals. These are billions and billions of dollars of capital flowing into the space. My goal is to get out in front of that, to open as many stores as humanly possible, to do it in a multi-brand strategy. And by the way, I left this Portillo's down at the bottom, which is they branded as a hot dog place when I grabbed this little announcement of it. But even people like Berkshire Hathaway are in the space going for these brands. At 38 locations, that operator, that franchisor, effectively traded at $1 billion valuation. Again, I'm just a humble franchise store operator. I want to operate as many as possible, but this is where the exits come from. I saved this from another presentation. These were actual IPOs. Now, what's really telling about this is that the Freshie deal, which was a Toronto Stock Exchange deal back in 17, they only had 244 stores. They were double our size. They sold essentially 10% of the company got valued at $1 billion. It's fashionable. It's just fresh food, salads in a box, and rolls and bowls. Fatburger, right? Fatburger at 200 units raised $24 million in what was effectively, I believe, about a 10% stock sale. They've since leveraged that to buy Bonanza Steakhouses and others. Again, for those of us who are franchise store operators, do we really care what's going on at the high level? Well, yes, the reason we care is if we're part of a brand where that sort of thing happens, the tide rises or raises all boats, as they say. So we want to be part of that. Shake Shack, they had astounding AUVs because almost all of their stores were in Manhattan. Again, an acquaintance of mine was the chief financial officer on that deal. He said it took a lot of work to convince the street that they were not going to do $4 million when they got to Dayton, Ohio. But that brand has continued to open stores at a blistering pace. Yeah, their AUVs are falling off, but they still raised $100 million on a minority share of the sale of the company into an IPO at 63 stores. This is possible. Opening 60 to 100 stores a year is possible. Getting a substantial transaction that doesn't create the retirement of the people in the brand, that creates the upside opportunity to be part of a brand growing to 500 to 1,000 stores, like my brother grew with Subway over the years, and many of our operators did. I'll stop going into the details, but Wingstop, you can look them up yourselves. Again, 25 years old almost as a brand. It was just 4 years ago they did their IPO. They are trucking along. All of these brands, with maybe the exception of Freshie, are experiencing decent AUV growth. They're stable or increasing. Same-store sales, stable or increasing. And we're going to talk in a minute about the fast casual market. But first, I want to talk about why, in the context of these kind of transactions, be they private or public, why a multi-brand strategy changes the game. If you're in a brand today, like our operators have crossed over from everything from Tilted Kilt to Burger King and Subway, you can get landlocked in your current opportunity or your current brand. You can't build any more stores within your driving service area. We're using a multi-brand strategy, and we're doubling down, and by combining the two brands, Hothead and Rapid Fire, into building opportunities, we could capitalize on these 4,000 to 5,000 square foot retail boxes that are available. They're shoe stores, they're video stores, formerly sporting goods stores. They're not suitable for traditional fast casual, or even fast food. And to that extent, you're not even seeing the full service operators take them. But they're, in many cases, prime retail locations, like one that I'm converting now. And if you have two brands, you can control the entire space. You can also split them down, as I describe in the bottom left quadrant here. You can, put 2 or 3 units in there if you want to. We're going for the large alcohol self-pour formats in the 4,000 to 5,000 foot spaces, but you could just as easily, if your market doesn't have alcohol available, like Pennsylvania or New Jersey, you could go with multiple fast casual, but you can control the Mexican and the pizza side by side. We even have build-to-suit partners that will put these buildings up for us. They're building for other brands. If you notice, Blaze, Mod, Qdoba, even Chipotle and Jimmy John's and many other national brands expand through small shopping centers, 2, 3, 4 unit centers. It's not uncommon to see Blaze or Mod and Chipotle in the same building. We've embraced the same strategy, and the same people who build the buildings for them will build them for us. A multi-brand strategy gives you market density opportunity. As I use this because it's real. Ray was a Subway guy. Again, Ray's my brother. He founded Hothead and Rapid Fired. He was possibly going to dial in today. I don't think we have him. But Subway he built for many years in Dayton, Ohio. They actually got overdeveloped. That's when he crossed over and created Hothead in the same market. He didn't sell all his Subways right away. He put Hotheads next door to Subways. Then when he created Rapid Fired, he put Rapid Fired next to Hotheads. If you control multiple brands, you can still contain your service area to that 50 miles in any one direction radius, but you can double or triple your density. It allows you more flexibility with your people. It allows you to capitalize on real estate opportunities, those insider leaks on buildings and landlords and city council people telling you where things are going and where stuff's going up. If you only have one brand, you can't do it. If you have 2 or 3 brands, you have all kinds of flexibility. And if you're going to do this in fast casual, I'm sure you've read the articles. If you're tracking the space, it is becoming competitive. There's a half a dozen salad concepts. There's 3 or 4 people in fast pizza beyond Blaze and Mod. We believe we're better and we execute better and we have more variety, but alcohol is game changing. It has not been a miracle cure. It's not an overnight thing, but to go from 1% alcohol to 5 or 10% and to create a casual date night kind of environment on Fridays and Saturdays that packs the dining room and has your customers dropping an extra $10, $12, $15 per ticket, it's game changing. Same thing in our Rapid Fire brand. We experimented first with self-pour in one of my stores. We've now deployed it as retrofits to one of the stores. You can see one in progress there. Again, it has not changed us into a bar. It's created an add-on that's a $5, $10, $12, $15 add-on that makes alcohol, which is a relatively profitable cost of goods item, as much as 5 or 10% of sales, and then instead of a nagging 1% of sales of bottled beer, wine, and cider and such, that isn't worth having a liquor license for. So this all comes together, and I'm going to reiterate where we started in this segment. It's a win-win-win. To me, it's about the end game. To my son, who's 32 years old and is building and operating some of our stores, who is sort of the pilot for our multi-store sponsor owner-operator program, he isn't ready to retire in 3 years. But in 3 years, if the brand attracts attention and brand attracts capital and the brand gets density in the major markets, there's all kinds of efficiencies that come from advertising and cost and supply chain that he'll benefit from for years to come. For me, I just as soon have that private equity guy buy me out and let the young bucks operate the business. And I know many of our franchisees and my partners in the business feel that way, that, they're 50, 60 years old like I am, but they've got a lot of young 30 and 40-year-old management team members. Those folks will ride on to 1,000 stores. I just want to get us to 200. With that, Elena, I'm going to pop out and give you the screen back.
Yep. And on top of, the exciting events that are occurring in the race to 200, so you've got private equity, you've got other buyouts, non-IPO buyouts, going public, et cetera. What's really exciting that we're going to get into in this next segment is that the fast casual space is outpacing the rest of the restaurant space. All this does is amplify the opportunity. So not only do a lot of things happen in the race to 200, but the actual fast casual space within the restaurant space is just as consistently outperforming overall restaurants. So Chris is going to dig into what are some of these unique industry dynamics in fast casual. So go ahead, Chris.
Perfect. Thank you, Lena. Everybody get a break. And let's do one more poll real quick as we drop into this one and see who's tracking the space. Which factors do you believe are really driving this meteoric rise of fast casual? Have you been tracking it? Are you paying attention to it? Are you competing in it every day? Please take a second, click in, pause doing the email and all that sort of thing. Hopefully I'm not boring everybody. Thanks for playing along. We really appreciate your attendance and feedback you give us during these events. And again, if you want to share these after the event, the highlight reels are available on our YouTube channel. So you don't have to spend an hour sitting there in the middle of the day. You can watch them with your leisure with a glass of wine. Thanks for you guys who voted. And let's see what everybody says. No patience for table service. That is a big driver. Families with young kids have figured out sitting around at an Applebee's is not very conducive to 3 small kids and 1 in a high chair. The demand for any way I want it, we're going to talk about our view of that. It is absolutely about massive variety, any way I want it, but it's also about accommodating 2 tracks of customers. We'll talk about that. And fresh everything. I want it in front of me. We even have a steakhouse operator who crossed over to become a area developer for us, who said in their steakhouse concept, people wanted to see the steaks cooked in front of them. Interesting, nobody picked availability of alcohol with meals. We are finding, and Ray has always believed, that having at least bottled beer, wine, and cider available was a location decider factor. And I know when I was raising my kids, I chose a place where I could get a beer while we went to dinner. Technology enabled everything. I think that everybody's in that space. Fast casual was first to it because we were newer, but we are definitely seeing, the McDonald's of the world are coming into that space, and they are not messing around. In some cases, they are even acquiring the actual technology players to protect it for themselves. With that, let's talk about this market. The fast casual versus quick service restaurant space. Again, I'm going to try to avoid reading the slide to you, but the essence of it is it's 3 times the rate of the QSR segments. The growth is occurring, and it's literally cannibalizing the limited service quick service. I'm going to talk about burgers and chicken and other concepts or categories relative to pizza and Mexican in a minute, but think about it this way. Fast casual was an idea back when Chipotle launched. It went from 10% to 22% between 2011 and 2017. It's forecasted to be more than 33% of the fast food market, literally in the next 24 months. And what's amazing is the top brands in the space are achieving triple-digit year-over-year growth. It's really insane. That is largely driven, as my brother Pete likes to point out, by opening stores. It's literally opening stores. So is it same store year over year? We're getting same store year over year sales increases in a lot of our operations. Many brands are, but fast food by and large is almost flat. Fast casual is getting substantial year over year same store sales increases, which compounds the growth if you're also opening more stores every year. The compounded annual growth, or CAGR, in this space has been 9% average annualized growth. So if you're investing money in anything, if you're looking at your Edward Jones account and thinking, is my investment growing 9% a year? Probably not. It is in fast casual. It's not in restaurants in general. Restaurants in general, as you see, at about 3%. And this information we grab, this is public information that you can take a look at on your own, published by various parties. So let's talk about riding the wave of consumer demand. What has defined this fast casual space? It's really 6 things. We talked about it a minute ago, but you could sum it up as craveability, control, and speed. People want to know what they're getting and control how it's being made. They want to tell you how to make the pizza or how to make the burrito. In the salad concepts, same thing. In the soup concepts, they mix it together the way they want. Craveability is the second part. If you don't have a concept that drives people in potentially weekly, I realize a lot of our clientele comes in every 60 days, but even them, when you talk to them, think they came in last week or last month. If you're not craveable, and craveable comes from such custom product that they make that weird pizza or burrito the way they want, and speed. When they come through the door, they are not up for an hour-long experience. People coming to a fast casual location, even with our alcohol, as soon as they're done with their last bite of pizza or burrito, they are finished drinking. That's part of the novelty of self-pour alcohol. You could buy a pint and a half of beer, or a glass and a half of wine, or 1.5 margaritas. But the bullet points are there, right? They're coming away from the menu concepts. They don't want to be told what to order at Applebee's. They don't want to pay the price of a Red Lobster, although people still very much do. They see it as trading up to increasing the quality. It's an aspirational thing, and we're starting to adjust our marketing in that direction and focus on, again, fresh everything any way I want it, sort of repeating the themes This chart was a technomic chart, but I thought it very simply portrayed where we fit in. We're in the higher price category in the fast food space. So we have the advantage of being the streamlined, simpler operations, but we have the opportunity for a higher price point, albeit we have pizza operators who charge $13 for the same pizza, and we charge $8 or approximately $8. We're still aspirational in terms of the quality of the product and the freshness and the uniqueness of what's being prepared for the customer, and that's what people are moving to. I talked about this a couple times earlier. Let's illustrate it. So this is a stratification of the top 50 QSR brands from QSR Magazine. I just repackaged their data. Here's the point of this slide. There are many, many brands. If you notice the blue column, the first one, burgers, there's 14 brands that made the top 50 with 40+ thousand locations in the burger space. Entering the burger space is massive competition. You see announcements from those CEOs, and they are fortressing themselves. They're getting every corner where they can. The density is insane, and the fact that there's 14 brands in the top 50 gives an amazing amount of choice. Ray and I were just talking the other night about how in pizza we were concerned there's so many pizza choices. Well, it doesn't remotely compare to sandwich or burgers. Chicken, ironically, doesn't have as many locations. It's among the fewest except for Mexican, but there's 10 major brands out there selling fried chicken, ranging from Raising Cane's, which is tearing it up. Who knows why, but it works. Chick-fil-A, you can't franchise that concept, but they're tearing it up, and they have the highest AUVs in the industry. But set aside burger, chicken, and sandwich, we are squarely focused very deliberately back to decisions made almost a decade ago on Hotheads and 4 years ago on Rapid Fire. We entered both of those markets when they had 500 units or less. When there was a handful of competitors. We think we're doing it differently with a true second mover advantage, with greater speed, greater variety, and a different feel and experience for those customers. And we're piling onto that with the fast casual alcohol, which we'll talk about again in a minute. All of it doesn't amount to a hill of beans if you don't have the average unit volumes. Our AUVs are squarely in the middle of the major brands that are not legacy brands. So let me clarify that. The blue columns represent the 22 brands, the Burger Kings, the Arby's, the Wendy's, the McDonald's, that have been around a long time and tend to be in freestanding locations, tend to be very high density in the markets, so that they have the advantage of advertising lift because they have so many stores. They have top of mind lift because you drive past their stores every day. We are just behind them in that the nominally $1 million range, $650 to $1 million a year stores, depending on our older, smaller locations and our new, higher profile in-cap locations. Both brands are fighting it out in that space to be nominally $1 million stores. Our goal is to get more density in each market, like we have in Dayton or Cincinnati, where we have a couple dozen stores and we can afford billboards and radio and the full complement of advertising. As we penetrate markets around the country, at again around 112 stores between the two brands, we're in a lot of markets where we only have 1 or 2 restaurants in the market. It will take time to get the density, but equipped with our team of area developers, we believe we can get the density quickly over the next 24 to 36 months, and that density, visibility, and advertising budget will give us the opportunity to slide into the same AUV levels that those legacy brands occupy. Our AUVs today, top 25% in the Hothead brand are in that $1 million space. They're $890 to $1 million. And we've seen a very strong year when we really we redoubled, or maybe redoubled is not the right amount. We increased advertising allocations in one of our markets by 1%, almost doubling the advertising budget through agreement of all the franchisees. It is pouring on the gas. We've had fantastic results. Our social media programs are helping drive those AUV increases. Again, it's not published data yet. It'll be in next year's FDDs. But the point is, we're on that quest to crest $1 million AUVs. That's not our AUV today. You can see the numbers. You can get an FDD if you're interested. The Rapid Fire brand, which is younger, it's only a couple of years old. Again, I operate both brands. I have 2 stores of each brand right now through our pilot. That is the basis for our rapidly expanding national store development program. We'll talk about in a future event. but the rapid fire stores tend to be a slightly higher price point. It's very similar, actually, but we believe there's potentially higher upside in the pizza business. Pizza is more ubiquitous, but you could argue both sides of it. We operate both brands for a reason. When you you find a great shopping center, there's bound to be either a pizza restriction or a Mexican restriction on it. The optionality of going pizza or rapid fire or hothead, the optionality of taking a building and putting in both is game changing. It allows more stores in a smaller market, so you're not driving as far, you're not spread so thin. We like both brands a bunch. I operate them. I am not the franchisor. I'm an independent franchisee. Obviously, my family family members helped create those two brands. But we're here because you can't franchise Chipotle, but you can franchise our brand. You can't get the big markets from Qdoba anymore, but you can get them with us. And the same thing's true with Blaze and Mod. The big markets are spoken for. With us, we're coming in, second mover advantage, and attacking those markets. We'd love to have you join us. We serve in fast casual truly the hottest demographic that's out there, that 25 to 34. It's interesting, the bias to male or female, but it's childbearing years, right? It's young families, it's young parents. They're on the go, they're moving fast, they're extremely active on social media. We have had a huge success driving the brands, driving product awareness over the last year in some very aggressive experiments with social media. This chart's actually dated in terms of the counts. I'm wagering the bet they are probably double this today. But let's face it, we have a relatively hot economy. We have very, very low unemployment. We have people spending money on fast food and saying in survey after survey they would eat out more often if there was more choices. Well, we're trying to deliver those choices. And we have partnerships that can help us do this. As I mentioned, if we control both brands, or if you're an operator in a market that chooses to get involved in both brands or one of them, we can do buildings with both stores in them. It's a real estate opportunity. And again, put your attention back to Chipotle, Qdoba, Mod, and Blaze, who almost entirely did their expansions to retail strip center locations, many of them through build-to-suit partnerships. I know the people who built the buildings for them. So they've kind of plateaued, and now they're coming down market to guys like us that are emerging brands. The partnerships are there if you have the net worth and the commitment to go do it. With that, I'll take a pause for a second. Elena?
Yeah, absolutely. So if any of these three sections, look, we've got great industry dynamics in an exciting industry, and we think a very unique second mover advantage. So we've talked about this in earlier webinars, but we like to usually close with this, is that we also have very unique capital structures for you to participate. So we're going to end with the 4 ways to participate, again, based on your background, if you're just pure investor, if you're a pure operator, or somewhere in between. So with that, back to you, Chris.
All right, everybody, I have one more poll for the audience, if you'll indulge us. We'll be wrapping this up here in about 8 minutes. I'm going to go quick. But what's the primary factor limiting your participation in the restaurant space? Are you new to it? Are you seeking capital? Are you a capital investor who's looking for operators? We believe the world converges together around these things. I appreciate a chance to get a sense of who's in the audience, and I hope you're enjoying the information you're seeing. Hope it's either validating your assumptions or causing you to think differently about what you're going to do and how you're going to enter the space. Thanks, everybody, for participating. That's interesting. Usually you have a lot of folks on the call who've saturated their current market. And that's the traditional folks crossing over from other brands. Not enough good locations is something that our partnerships can help with if you get involved with our brands. They are, again, build-to-suit partnerships. We'll talk about those in a second. Limited capital to invest is also part of our program. We have a program for sponsored owner-operators and joint ventures. We'll talk about how that works. And if you don't have any limitations and you're just checking out the space, I hope this is providing some meaningful input into how you're thinking about it. Let's get back on track. We'll wrap this up real quick. So there are 4 ways to participate with Wiley Development Group. Again, we are not Rapid Fire Pizza and Hothead Burritos. Those are my brother's companies. He founded them with a group of partners. I come from capital markets and have been in consulting for about 25 years. My brother Pete has been with them as a consultant for their marketing programs for the last decade or more. We saw an opportunity when we helped my son come out of the military and launch, or with the dream of launching a multi-store program of his own. And we put together Wiley Development Group to frame that up, and we realized we can reproduce it and help a lot of other people. So we have 4 programs, 4 ways to participate. One is as a sponsored owner-operator. We'll talk about that in detail in a second. Joint venture market partners are people who are already in a market, already operating a brand, solidly underway, but could go faster with more capital. JV Limited Partners are the folks who've approached us, their friends, their family, their local people who love the brand, family offices, who want to invest. They want to be close enough to the operations to drive out and claim them as their restaurant. They do not want to get their hands dirty. And anybody in this audience is certainly welcome to become an independent franchisee or area developer with either brand. We'll help you make those connections. We're here to help, but we specifically are a franchisee and an area developer, and there are many markets those folks get into. Let's just do a quick recap of those in our remaining 5 minutes. A sponsored owner-operator, this was built after what we did with my son. This is for the aspiring but seasoned manager, either managing in another brand or come up through the ranks somewhere else as a corporate employee, or they're coming out of the military with solid military experience. They understand a mission. They understand following direction. We will participate with those folks in markets where we have an area developer on the ground, and we will help that person become a franchisee in the system in either brand with the specific intent to get them to 3 to 5 stores, just like we're doing with my son. And we've put together a system to support that, and it's in conjunction with the area developers. You'll see a map of where they are in just a minute. We back them up with cash, supporting the leases and the financing. They get a chance to earn their way in through sweat equity, but it's real equity in the business, so that after 3 stores, they don't need us anymore, although I'd be surprised if they went on without us. Joint venture market partners are folks that literally are in a market with 4, 5, 6, 10 stores or more. They're just saturated. They can't put in any more Subways or Qdobas, or maybe that's not a good example. No more Subways or Burger Kings or Arby's or whatever their other brand is. They want to double down in their same market. They know their landlords. They know their bankers. They're just looking to put another brand in their shopping centers. So in that example, our objective is to help accelerate the expansion of that joint venture market partner. Much like an area developer, they operate, we help capitalize. If they're going to try 1 or 2 stores, why not do 5? We're here to accelerate it, and our limited partners will benefit from that program. The limited partners who are in the wings with us to expand will be not only in stores that we're operating with a sponsored owner-operator, but invest with us where we have a joint venture operator who's managing a market, who again has an office, has the trucks, has the supervisors. They're just adding a brand to the market. And so for limited partners, they're diversified across multiple restaurants. We're employing the same kind of models that my brother has used in his business across their roughly, I think about 24 corporate stores. Variety of partners participate in each one as they go. It's all about having a portfolio of stores. And I'll close out with the opportunity to become a area developer or a franchisee. You don't need to have anything to do with us at Wiley Development. This is just symbiotic. It's a collateral benefit of being, brothers with the guy who founded the brands. If you don't need our money, if you don't need our support, if you don't need a partner, you can sign up in the states that are on the map here as a franchisee and just go build your own stores. In the markets that are green or blue, you have an opportunity to become an area developer and control either a regional market like Houston or half a state, depending on your financial capacity and your experience in a competing brand or a similar brand. So we can help you make those connections. We'll share the inside experiences that we've had over the last couple of years of doing this and help you get engaged in the system. Again, you can't franchise Chipotle. All the good markets are gone at Blaze. Same thing mostly for Qdoba. They're not quite in all states. They sort of stalled out. And even brands like, again, Mod Pizza, a worthy competitor. We believe we're faster. We believe we have more variety. We believe the alcohol is game change, even though they have it. They're not doing it the way we're doing it. And you can go control an entire market. So there you have it. Just a quick summary on the screen. I'm not going to read it to you. We look forward to helping you. If you're interested in getting in touch with either brand or with us, you can certainly reply to the invitation. The invitation will cause you to get a link to a recording. If you enjoy the recording, you can certainly share that with your friends. You can also, again, go to our YouTube channel. Just search for Wiley Development Group on YouTube, and you can see 10 and 15-minute segments carved out without the polls, without all the noise, and simply cut right to the pieces of this that you might care about or want to see. We have about 13, I think, segments on that system today. So thanks again, everybody, for joining us. We really appreciate your participation. We have finished 2 minutes early, which is a remarkable accomplishment, and I appreciate that everybody rode along for the whole event today. Have a great day, and hope this expanded your ideas about the fast casual market. I'm signing off now. Good night.